So do the Italian election results really matter that much to American investors? Should they?
Yes, because a hung-up Italy, difficulty in finance, difficulty in reforms, European Central Bank stays the course with lower interest rates, may get an easing. Draghi is flirting with that now because the whole...
Mario Draghi, the head of the central bank.
Yes, the whole of the Eurozone is in recession. The only thing left standing is Germany, and it, too, is in questionable recovery mode. If you take the world and all the 4 central banks of the world, yen, pound, dollar, euro, are in easing mode at a 0 interest rate, for markets, for assets, that's bullish. For the
bullish in nominal terms as opposed to real terms?
Well, because until you get an output gap closing, that's the slack in the world, of which there's a lot, you don't get the inflation, but you do get the money and the prices rise. All over the world, Japan, here, the UK is going to go into recession, print again. That's where we are. That's the new world, just like our rotten government in Washington.
That's the new world and a rotten government in Washington. Marianne Bartels, if indeed the European Central Bank lowers interest rates, do you then have to go back to your models, and do you then estimate that equity prices will rise even further, as David says?
Well, we still think equities are going to rise, and certain sectors are already in a bull market, like healthcare, staples, transportation, consumer discretionary, and lower rates are very bullish for riskier assets. So any type of monetary easing, which we've been in for a number of years, has shown to have a wealth effect. And it's actually been bullish for stocks, and it actually has been bullish for the bond market.
Have we seen the worst? You were talking during the break about how, from a generational point of view, the 2008-09 decline in the market value, that was it.
That's it. That's the generational low. We would equate it to the 73 low, which is the last time the markets were range-bound. We don't think you're ever going to see that level in the markets in your lifetime.
Why not?
Basically, when we study the history of markets, there are periods where markets stay range-bound for years, and you'll get marked a generational low. And we do define 08-09 as that generational low. Now, the trading ranges can last 15 to 16 years, so they can be a long time. But the question is, what we have different this time is so many central banks having monetary easy policy that maybe you can go into a bull market even sooner. So there's certainly a lot of stocks in a bull market.
David Kotok, if you have low interest rates and no one wants to own your currency, doesn't that mean that you're always searching for a currency that's going to give you a better rate of return?
Yes, but when all interest rates are low,
right,
0, all currencies look alike. So you get one currency at the expense of another, but all currencies have the same problem now. They're all at 0 interest rates. And I totally agree with Marianne. We saw the lows in 09. We are not going to see them again, ever. We are massively higher at the end of this decade. Massively higher. There's a 2 in front of the 1,000 on the S&P when we hit the end of this decade.
Do you think we're going to get 20,000 on the on the Dow Jones Industrial Average?
A rough equivalent would be something like that, yes. All assets move higher. When you value against 0 interest and you have some growth, some income...
How can the cost of money stay so low if the world then becomes so flush with wealth, as you described?
Because wealth has a very small creation of consumption and stimulus. Income is what you need to get a big bang for the buck. And what do we have? Governments taxing income to crunch it, so wealth wins and income struggles. That's a lousy recipe for the long term. But for the investing class, that's great right now. For the long term, it's bad for the nation.
Marianne Bartels, if you were to take all this information, plug it into a model, but then add to the fact that we have this dysfunction in Washington and we might get these automatic budget cuts, what does that do to U.S. GDP?
Well, our firm forecast is saying that sequestration will happen on March 1st, that they're not going to avert it.
That it will happen.
It will happen, but it's not going to be $85 billion. It'll probably be closer to around $50 billion in actual cuts, and that will equate to at least 0.5% of GDP to growth, for growth. And for the whole year, we're forecasting as a firm 1.4% GDP growth.